Let's talk about how to do a mini cash out using your current escrow account when you refinance. So understand the mini air quotes. That's why I'm holding up the fingers and doing little bunny ears as I do it. Mini cash out is just a term I'm using. I'm not saying I made it up, but made it up. It's not an industry. It's not a technical term. It's not something that if you just went down and told your neighbors you did a mini cash out, they wouldn't know what the heck you're doing. There's no button that the mortgage industry pushes that say mini cash out. So understand the reason why I call it a mini cash out. So it is not what we're about to talk about is not doing a cash out, not doing a home equity loan. In Texas, those are known as A6 home equity loans. So we'll put a link somewhere around here that you can check that out as well. This is not that. So here's why I'm explaining what a mini cash out can be and using your escrow account to get cash out. So I'm going to use Texas. Every state can be different. Some states are similar, some states are different, right? So I'm not saying every state's different, but in Texas, let's use this example. It's for this to be applicable to you, you need to have a current escrow account with your mortgage. So if you don't have an escrow account now, you can push pause or push stop, whatever it is, that's fine. But if you have an escrow account and you want to refinance, or when you do your refinance, whenever that may be, now or years down the road, you have an escrow account. So just a refresher, escrow accounts are like a piggy bank where every month you're making 1/12 of your mortgage payment, 1/12 of your insurance payment, and that's going in with every payment. It's going into this escrow account, right? So, and by the way, some very rare, but some mortgages only pay insurance and some only pay taxes. But for the most part, we're going to say the vast majority of escrow accounts, you pay 1/12 of your mortgage or 1/12 of your taxes, pardon me, 1/12 of your taxes, 1/12 of your insurance. That goes in this piggy bank. Okay. And it's your money. It's your money. If you pay off your house, you win the lottery and you pay it off, or if you sell your home, it's your money. The same goes for a refinance. When you pay off that mortgage, this money is yours and it comes back to you. So it gets refunded. So if you were to close on a mortgage, and I'm going to use, let's just say the month is going to be of this closing. Let's say it's October. So you're going to close in October. And when doing so, you have, I'm making up a number here. Everybody's escrow accounts are going to be different, but let's say there is $7,000 in this escrow account, right? And what the reason why October is a good month to use is that's about when property taxes come due in Texas. That's where you start getting the bill and the notice that says, hey, property taxes are due. So maybe this is a September closing, early October, whatever it is, before the property taxes have actually posted, before you owe that money. You should have a lot of money in your escrow account because for the last however long you've been putting 1/12 the taxes in there. So you should have, in my example, I'm just making this up, $7,000. It could be a lot more depending on the house size. It could be less, but for the most part, you got this money. So when you do a refinance, and whether or not you want to set up a new escrow account or not, does not matter. This $7,000 in my example is your money. So after closing, the mortgage servicer is going to realize, oh man, we just closed this loan. We no longer need to hold this escrow account, even if it's the same mortgage company. And I'll talk about that in a minute. But they're going to say, man, this is your money. So typically, not always, because I can't predict every mortgage company how they're going to work, but typically you'll get your refund check, your escrow refund, within about 30 days of closing. So you close, you fund, you're done. You should get back that escrow account within about that 30-day window. So maybe it's 60 days. Again, I can't speak to all mortgage people, mortgage servicers out there, but you'll get that money back. And that's why it's a little bit of a mini cash out. It's your money to have, to hold, to keep, to cherish, and love. But here's what you need to understand. The money's still due, right? You still owe property taxes and you still owe insurance. So now the question becomes, what do you do on that new loan from an escrow account standpoint? If you choose to waive taxes, waive your escrow account, let's say you choose to waive you don't need to do it and you choose not to do it on the new escrow or the new mortgage, there's no escrow account. Guess what? You got taxes due like pretty quick. In my example, I said it's October. Again, taxes post usually about early to mid-October in Texas. So now all of a sudden, within the net before January 31st, you got to write a check for the tax bill. So that mini cash out, that may not be your money. You better hold that because you're going to need to pay the property taxes if you didn't set up a new escrow account at closing for the new mortgage. So that's the part that you got to remember. While this is your money to keep and you can do whatever you want with it, you go to Vegas, just realize the tax man's still coming, knocking, saying you owe us property taxes. And whenever your homeowner's insurance is due, same goes for the homeowner's insurance. They're going to come knocking saying, hey, you owe us money. So if you didn't set up a new escrow account on the new mortgage, realize those bills are still coming due. It's just now your obligation to pay them. So consider that. So now let's say you do set up a new escrow account on the refi. Now I'm going to like, okay, cool. I'm going to set this up. Well, what that means, guys, is either one of two things. You're either going to have to write a check at closing to set up the new escrow account, which, by the way, in my example, if it's $7,000, the check or just the amount, the check may be bigger, maybe smaller, but we'll talk about that in a second. If you end up writing a check at closing, or if you do, it's going to have to cover the $7,000 they just gave you, plus probably another month or two of the escrow payment. So it could be $8,000 or $9,000 that you have to write a check for. And like, hey, wait a minute. How does that make sense? How did this mini cash out refi suddenly go to me writing checks more than it is? Well, it makes sense, guys, right? Because it's $7,000 that you're getting a refund. Again, that money is allocated to pay taxes and insurance. So now that they're going to charge you, say, 8 or 9, it's because you get to skip a month's mortgage payment after closing. Typically, you get to skip a month's mortgage payment. We'll put a link down below to talk about that. So you need to account for that non-payment month by putting in more so that when the taxes are posted and come due, there's enough money in that piggy bank to pay for the taxes. So, and then when the insurance comes due, whenever that is, they got to have enough money to pay for the insurance. So you have to understand it's not free money. It is a mini cash out, and you'll get cash in your bank account after closing, but it's not a mini cash out in the sense that you can't, it's not free money. There's nobody's just going to give you $7,000. But if you've already accounted for it, you can do it. And the way around that is a lot of folks do have equity now because it's been such a good run in the housing market as of late. So instead of writing that check for $9,000 in my example, or whatever amount that would be, you can roll that into your mortgage. And that's how the mini cash out happens, to where it's like when you take that, what would be check for $9,000 of just the escrows, you can take that and add it to your loan balance. And then the $7,000 you get, it's yours. And it always was yours, but now you don't need to worry about paying for the pending taxes or the upcoming homeowner's insurance, because now that money has moved from, into your pocket, but now your loan balance has grown to where it's like doing a mini cash out. You don't have to pay the cash out rates because those are higher. You don't have to do all the cash out paperwork. You just get to keep the $7,000 because now a new escrow account has been established and you've rolled it into your loan balance, which then keeps the money in your pocket. So I understand this is a lot. I would just say watch the video again if you need to know it. Certainly we'll walk you through it, but we're going to tell you the same thing that we're showing you or telling you now. Certainly we'll show it to you on paper so that you can see it. But just think about it this way. Piggy bank with escrows. And when you close, they give it back to you. Now, if you set up a new escrow account, you basically got to replenish said piggy bank. So then, you got to add that money there, and then you got to add an account for any non-payments for the next month or two that you're not going to make, depending on how you structure the mortgage. And that goes up. So let's just, in my example, call it 9. Now, whether or not you write a check at closing for $9,000, and by the way, that's a net. Let's pretend you did write that check for $9,000. That's a net zero to your bank account when you zoom out about 90 days. Why? Because if I write the $9,000 check, I'm getting back my $7,000 refund 30 days later-ish, right? 30-ish days later. And then I'm also not making a mortgage payment for a month in most cases. So by skipping a month's mortgage payment, whatever that amount's going to be, that kind of makes up the difference for that $9,000 I wrote out of pocket. So that is the difference of how you do a mini cash out refi. I'm not saying you should or shouldn't. Everybody's going to be different and unique. There are things where you can do what's called net. You can net out your escrows. They'll put another link somewhere down around that. That's not for this purpose, but net escrows is a way to do it differently. But again, check out any additional videos. Watch this one once or twice. Certainly, as always, call us. We're happy to answer any questions you have. The Mortgage Mark team is here. And like I said, this is complicated, but again, it makes sense once you understand it. But call us if you need us. Thanks for watching. And as always, when you think mortgage, think Mark.